We're continuing our Chapter 10 discussion on the home purchase process. We're talking about having your home evaluated to make sure that you understand what the price is going to be and based upon what factors. There are also economic impact conditions that will impact the price of your home. Okay? So, depending upon how the economy is going, whether the economy is going well or whether we have a weakened economy, that's going to impact the value of your home. As demand for homes increases, prices are going to rise. So when that takes place, we call that a seller's market, meaning that there's a high demand for homes, therefore the price is going to increase. When the economy has been weakened, less jobs, people are not working as much, income is declining, there's going to be a lesser demand for homes, causing homes to have a lower selling price. So the economy does have an impact on the actual valuation of a home. So let's put it all in a graph format. When there's a strong economy and you're having high income of household, people are confident they can afford their homes. The demand for homes are going to go up while the supply of homes are going to decrease, providing you with the price of homes are going to go up. But when there's a weaker economy and lower income of households are not confident that they can afford a home, that will cause the demands for homes to actually decrease, whereas the number of homes available are going to increase because they're not selling fast enough, and that will cause the price of homes to actually decrease. So again, economic conditions do play a role in the actual value of your home. This website, Realtor.com, allows you to see what are the sales price of homes in a specific area that you're considering buying a home. And again, your real estate agent can also provide you with the same information, and often they're going to have the most up-to-date recent pricing on home. Okay? Impact of the financial crisis on home values. So when there are financial crises, mortgage defaults, meaning that people are not able to pay their mortgage, and once they go what we call default, there's something called a foreclosure, which means that the mortgage company is going to take that home away from the homeowner. Okay? Impact on the home prices. So again, when there is a financial crisis, often home prices are going to decrease because of the mortgage default. So often banks are going to be the mortgage company. These are banks. They're not landlords. So when homes have been foreclosed upon, typically banks will sell them at a lower price because they don't want to keep that inventory. And so when you have mortgage defaults, it does have an impact on home prices. Resolving the crisis, well, back in 2008, they passed what's called the Housing and Economic Recovery Act. Because what was taking place is that there was a crisis back in 08, 09, 2008, 2009, and a lot of individuals were losing their homes because of scrupulous loan practices where they were signing loans and they didn't understand what they were signing. There were homes that were being appraised at a higher value than what they really worth just to sell those homes. And people saw themselves stuck with these horrible mortgages and they could not pay it and eventually end up losing their property. And so they changed the way that you apply for loans now. They've changed the actual mortgage application process so that you have more updated information. And now they have organizations that are going to regulate mortgages to make sure that there are not any type of unfair practices against those trying to get a loan. Okay? The effect on business activity and zoning laws. So when there's business activity, that typically increases demand for housing in an area. So when there's going to be, say, new construction, a company is coming to a certain area, they're going to need to hire employees. They need somewhere to stay, and that will impact the demand for housing in that area. Zoning laws may affect desirability. Now, there are certain type of zoning laws where zoning meaning that there are certain type of areas where there's a lot of what we call commercial zoning, meaning that in that area, they're only going to have commercial businesses, where others could just be a mixture of commercial and residential, but zoning can have an impact on whether someone can actually purchase or even build a house in that area. Okay, so when it comes to your home evaluation that you're going to get from the agent or the brokers, we're saying often the broker represents the sellers. However, you can have an appraisal done to make sure that the value they're saying your home is worth is the actual value of your home. Okay, negotiating the price. Most sellers will accept less than their asking price, but again, it does depend upon the economy. It depends upon what's going on. If there's what we call a seller's market and there is less inventory available, then the selling price often will not accept less because you have multiple people who are putting offers on the property. And so the seller would often take the highest bid. So the seller may accept your offer. They may reject your offer that we call a revision, which is known as a counter offer. So let's say you may put in a contract for $120,000, although they're asking for $130,000. They may counter back at an offer of $124,000. And so once the parties have agreed, they're going to sign a contract with the agreed upon price and any other conditions pertaining to the home purchase. Okay? So traditionally, again, the cost of purchasing a home, down payment, you'll need about 10 to 20% of the home purchase price to put down. That includes your down payment required as well as your closing costs. Now, your home serves as collateral. What does that mean? Again, it means that if you're not making the required monthly mortgage payments, then the mortgage company has the right to take your home. Get some water. Because again, your home serves as collateral to protect the actual lender to make sure they're going to get their money back. Now, you may be able to put down a lower down payment because there are loans that are backed by the federal government, such as FHA loans, which are Federal Housing Administration, or VA loans, Veteran Administration. Sometimes with these type of loans, they may only require a 3% or a 5% down payment if you can get a loan through one of these type of government-backed loans. Okay? Maintenance of an escrow account required. So escrow account is funds that have been set aside, and those funds have been set aside. So while you're going through the actual mortgage process, it shows the buyer that you're serious. And if the seller backs out of a contract and there's no fault of, if the buyer backs out of the contract and there's no fault of the seller, then the buyer may lose the funds they put into their escrow account. PMI insurance, which is private mortgage insurance, will be required if your down payment is less than 20% of the home value. Meaning that if you get a loan for $100,000, if you put down less than $20,000, you're going to need what's called PMI insurance. Again, this insurance protects the lender. In the case the buyer is not paying their monthly mortgage, but they do have this insurance policy, then the lender can receive the actual payment from the insurance company that you're paying the PMI insurance to. Closing costs. So when you're purchasing a home, there are fees that you must pay, which are known as closing costs. So the closing costs may include a loan application fee, There's something called points, which is a fee charged by the lender when providing an actual mortgage. So typically, let's say if they're giving you a loan for $100,000 and they may charge you what they call 1 point, which would be 1%. So the point would be 1% of the $100,000 would be a fee that's charged by the mortgage lender. Now, sometimes you can actually pay for points to get a better interest rate. What does that mean? It means that perhaps the bank want to charge you a rate of, say, 3.5%. But they'll say, well, you can buy that down to 3.25% by paying so many points. So that's a fee you're going to pay at the time that you're getting this loan. But the benefit is that you're going to have a lower interest rate over the actual life of the loan. Other fees could include a loan origination fee, which is about 1% of the amount you're going to mortgage, another fee that's being charged. There's an appraisal fee. They want to make sure that the property you're buying is valued enough to cover the actual loan. Then there's fees for doing a title search. You want to make sure that you're buying a home that doesn't have any liens against any judgment. Make sure there's no back taxes. There's nothing owed to the condo association. There on any contracts are saying that the homeowner owes them money. They put a label on the property. So there's a title company that would do title search work to make sure that property has a clean title, and they're going to give you title insurance, pretty much saying that we've done the work, we paid this fee, and you have title insurance. If anything comes back later on, then you can sue their title company for not doing their job properly. Okay? Now there are different types of mortgages. What we call a fixed rate mortgage would be our first topic. With a fixed rate mortgage, it's a mortgage in which a fixed interest rate is specified until maturity. So again, you may have a fixed rate mortgage of 4% and a 30-year mortgage. It means that for the 30-year time period, your rate remains constant at that 4%. You prefer to have a fixed rate when interest rates are expected to rise. So you're saying, okay, I'm going to lock in at this 4% now because the rates are expected to go up. And if I do not fix this interest rate, I may have to pay a higher interest rate later. So a fixed rate means you have a set rate over the actual life of that loan. You can go to the Yahoo mortgage section, and you can see what are the national average rates as well as the rates for specific regions and states. Even if you go to where you bank, your credit union, they typically will have information on what are the current mortgage rates, so you can have an idea of what type of rate you're going to expect. Now, the rate you're going to receive, your credit score does have an impact on that, but you can still get an idea of what are the current rates in your area. Okay, there's something called an amortization table that pretty much shows you how each of your mortgage payments are going to be applied. It will indicate what portion of the payment went toward the principal, meaning reducing the actual amount of the loan, and what amount was actually going to be applied to interest. Because yes, when you borrow money, you must pay a finance charge, which is known as interest. And every time you make a monthly payment, a portion of your payment goes toward the principal amount to reduce the actual loan amount. The remaining portion is what we call a payment of interest. Okay? So I'm going to stop here so I can take my time with this section. We're going to come back and take a look at a fixed rate mortgage compared to an adjustable rate mortgage. Stay tuned.